Welcome back to Brickonomics, the business of building. I'm your host, Nick Scoggs, and today I want to talk about pricing for profits, not for survival. There's a version of this business that almost every builder lives through at some point. The phone is ringing, the schedule is full, you're signing contracts and delivering projects, and you're building a reputation. But at the end of the year, when you look at what the business actually produced, something doesn't add up. You've worked harder than you've ever worked. You did more volume than you've ever done. And the profit, the real profit, the number that reflects what you actually kept after covering everything else the business cost to run, is thinner than you think it should be. It's not that you're failing, but you're not building wealth either. You're just surviving. And the reason, more often than not, comes down to pricing. Not the number on the proposal, but the thinking behind that number, where it came from, what it's designed to do, whether it was built to win work or built to sustain a business. Those are two very different intentions and they produce two very different outcomes over time. Most builders price reactively. They look at what their competitors charge, they apply an industry convention and what feels like a reasonable margin, and then hope that it works out. Sometimes it does, but often it doesn't. And the gap between what they hoped and what actually happened shows up quietly at the end of the year in a profit number that doesn't reflect the effort that went into earning it. This episode is about replacing the reactive approach with something intentional. Over the last 4 episodes, we've built the financial foundation: how to read your financials, how to cost a job, how to model overhead, and how to understand the difference between markup and margin. This episode is where all of that comes into a complete pricing model, not borrowed from your competitors, not based on what the market seems to accept, built from the actual cost of your business and aligned with the specific type of service your business is designed to deliver. Because that last part matters more than builders realize. Most people in construction have heard some version of this idea at some point in their career. Price, speed, and quality. You can only pick two. The conventional use of this framework is a client discovery tool. You ask a prospective client what matters most to them, you listen to which two they typically gravitate towards, and you use that information to understand how to sell them and what to emphasize about your service. For a long time, that's exactly how I used it. When we were early in our business and the primary goal was contracts, this was a very useful way to understand what a client needed so that I could position our service accordingly. Someone who led with price and speed got a very different conversation than somebody who led with quality and price. The triangle helped me read the room and adjust accordingly. But something shifted as our business matured. I started to realize that the triangle wasn't just describing three client preferences. It was actually describing three fundamentally different business models. And the implications of that realization were much larger than how to conduct a sales conversation. Take, for instance, price and speed or the production model. A business built on price and speed is optimized for volume and efficiency. Every process is designed to move fast and spend as little as possible. The product is essentially interchangeable. The client's primary need is resolution. Get it done quickly, and don't spend more than what's necessary. Restoration contractors are a clear example of how this model works. Insurance backed work, regional estimating guides, maximum allowable margins are built into the system. The business works because the volume is high and the process is repeatable. It does not work if you try to add service infrastructure that the model was never designed to support. The second model, price and quality, is what I would call the owner operator model. This is a business built on price and quality that delivers an excellent project at a reasonable cost. The client gets craftsmanship and attention that they couldn't get from a volume operation. The price is accessible, the relationship is personal, but speed is the trade off. And the reason speed suffers is structural, not incidental. When the service lines live squarely in the hands of one person, when the owner is the estimator, the project manager, the quality control, and the client relationship, the business can only move as fast as that one person can move. When they go on vacation, the project goes on vacation. When they get sick, the project goes on hold. The client accepts this because the quality and price justify it, but it's a ceiling that the business can't outgrow without being fundamentally changing what it is that it does. The third option is speed and quality, and I would call this the premium contractor. A business built on speed and quality has done something the other two models hasn't. It's built the service into the system rather than into the person. The trade off is price. Not because the work is overpriced, but because delivering both speed and quality at scale requires infrastructure, dedicated project managers, vetted trade relationships that have been built over time, logistics coordination that keeps material flowing and schedules moving, quality oversight that doesn't depend on the owner being present for every decision. That infrastructure costs money, and that cost shows up in the price. This is the model that we've been building toward. And once I understood that clearly, once I stopped seeing our pricing as something to defend and started seeing it as a reflection of what we've actually built, everything about how we talk to clients, selected clients, and price the work changes. The critical insight is this: none of these models is more right than the others. A well run restoration operation is a legitimate and valuable business. A skilled owner operator who delivers exceptional quality is exactly what some clients need. The systemized contractor is not inherently superior. What matters is knowing which model you are and pricing accordingly. Because pricing built for a different model will either undercharge your service or make you uncompetitive in conversations you don't belong. The clearest proof of this for us came from our experience with restoration work. On the surface, restoration seemed like an opportunity. Steady pipeline, insurance backed payments, and volume that could fill schedule gaps between larger renovation projects. What we didn't fully anticipate going in was that the restoration model is not just a different type of project. It's a different economic system with rules built specifically to suppress the kind of service infrastructure that we had spent years building. Insurance companies operate on regional estimating models that establish maximum allowable overhead and profit margins for restoration work. Those caps are not based on your cost structure. They're based on a regional average built for lean, low overhead operators, the kind of businesses that can deliver acceptable work quickly without the additional layers of project management, quality oversight, and logistical coordination that define our service. We had a dedicated project manager on every job who actively tracks the financial performance of the project and helps clients make informed decisions about where to spend their money. We have logistics coordinators who manage material schedules so that trades aren't waiting on deliveries. We have site supervisors whose primary job is quality and safety. And we have people whose entire role is keeping job sites clean and scored for adherence to our safety standards. In a renovation context, those people are features. They're the reason our clients have visibility into their budget in real time. They're the reason our schedules hold. They're the reason the experience of building with us feels different than building with someone who doesn't have that type of infrastructure. In the restoration context, those people are liabilities. The insurance company doesn't want to pay for a sophisticated advisor helping their client navigate the claim process. A client who fully understands their claim is a client who might push back on the adjuster's assessment. They might pursue additional coverage or dispute the original scope. Confusion serves the insurance company's interest. Clarity actually serves the client's. So the system is designed to keep the contractor's margin thin enough that adding service infrastructure isn't economically viable. And that design is intentional. There was also an emotional dimension that we didn't fully account for. A client who chooses to renovate has made a very deliberate decision. They've had time to plan, budget, and mentally prepare for the disruptions that come with a construction project in their home. They have the capacity, both emotionally and practically, to engage with a collaborative process. The sophistication of our approach is something that they value because they came into the relationship ready to use it. A client who's been displaced from their home by a flood or a fire is in a completely different state. Their primary motivator is resolution. Get me back into my house. Everything else, the quality of the trim work, the efficiency of the project management process, the financial tracking is secondary to that single urgent need. Our service model, built around collaboration and transparency and quality, wasn't what they needed. It was what we had, and those are not the same thing. The mismatch wasn't a sales problem. It wasn't a communication problem. It wasn't even an execution problem. We still did good work on those projects, and most of the time, the clients were still satisfied with the quality, but we couldn't compete on price with operators built for that model. And we couldn't deliver the speed of resolution that the emotional urgency of displacement required without compromising our standards, which defined our service. We were a speed and quality contractor trying to serve a price and speed client. The model incompatibility was structural, and no amount of effort can fix a structural problem. We stopped taking restoration work, not because it's a bad business, but because it's a different business, and trying to serve it with our infrastructure was expensive, frustrating, and ultimately unfair to those clients who deserve a contractor actually built for what they needed. Once you know which model you are, pricing stops being a guessing game and becomes a math problem. The work we did in episodes 5 through 7, understanding your financials, costing individual jobs, and modeling overhead by division, is the foundation, but it only produces a complete pricing model when you connect it to a clear understanding of what your specific service actually costs to deliver. Here's what that looked like for us. We took that divisional model we built for overhead, design, crews, production, management, and the GC umbrella and extended it into our estimating system. Each division now has its own pricing structure with rates derived from its actual cost structure. When the estimating team builds a proposal, they're not pulling numbers from an industry guide or benchmarking against a competitor's bid. They're pulling from a model built on our labor costs, our overhead allocation, our risk profile, and our margin requirements. The result is an estimate that reflects what it actually costs our specific business to deliver that specific project, not what it would cost a different type of operator to deliver a stripped down version of it. That distinction matters in practice. Our price includes a dedicated project manager who tracks job financials in real time and communicates them to the client proactively. It includes logistics coordination so that material deliveries align with the production schedule and trades aren't waiting on each other. It includes site supervision focused on quality and safety. It includes contingency for the errors, omissions, and price escalations that are a guaranteed feature of any residential construction project. A production builder, the kind of large scale operator who builds the same house type in the same neighborhood at volume, doesn't have those line items in their estimate. They can offer price and speed because they've traded customization and service infrastructure for repeatability and scale. Their model works because their client isn't buying a one of a kind custom experience. They're buying a known product at a known price on a known timeline. We can't compete with that price. We're not supposed to. Trying to match it would mean gutting the infrastructure that makes our service what it is, and then we wouldn't be able to deliver on speed and quality that our clients are actually paying for. What this approach to pricing does is it makes us quickly and confidently removed from conversations that we don't belong in. When a client is shopping 3 bids and 2 of them are significantly lower than ours, we don't apologize for the gap. We explain it. We walk them through the triangle. We help them understand that lower bids aren't wrong. They're just built on different models. If what they need is what those models deliver, then we're genuinely not the right fit for them, and we can tell them that directly. But if what they need is what our model delivers, the collaborative experience, the financial visibility, the service infrastructure, the quality standard, then the price conversation changes completely. We're no longer defending a number, we're explaining a service, and the clients who understand the difference are the clients who become great long term relationships. One of the hardest things to learn in a growing construction business is how to tell a prospective client that you're not the right fit for them. Not because you can't do the work, and certainly not because you don't want the revenue, but because winning the work would ultimately disappoint a client who came in looking for something your model isn't built to deliver. That conversation requires a level of confidence that only comes from pricing clarity. A builder who isn't sure their price is right will negotiate rather than disqualify. They'll adjust the scope, they'll discount the margin, take on the wrong projects, and spend the next 6 months managing a client relationship that was misaligned from the first conversation. A builder who knows exactly what their price covers, who can trace every line item back to real costs in a real business, can hold that number with confidence, not with arrogance, but with confidence. And there's a difference. The triangle is the most useful tool in this conversation because it creates a logical, non defensive framework for the mismatch. When a client tells me our price is higher than another bid that they've received, I don't defend that number immediately. I ask them what they know about how the other contractor operates. I walk them through the three models. I help them understand that markup percentages are not standardized units of measurements, that 20% on top of one cost structure looks nothing like 20% on top of a completely different one. And then I say something like, we'd love your business. I just don't know that what you're looking for matches what we can provide. That line does something important. It removes the adversarial dynamic from the conversation. I'm not telling them that their expectation is wrong. I'm telling them that there's a mismatch and that recognizing it early serves both of us rather than discovering it mid project. There's a specific version of this conversation that comes up regularly and deserves its own moment. Some clients want to be deeply involved in managing their own project. They want to source some of the materials themselves. They want to be the ones coordinating certain trades. They want to leverage their own time and effort as a form of contribution to the budget. And they want the price to reflect that contribution. I understand that instinct completely, but our service model isn't built for it. Our process works because every piece of it is coordinated through our infrastructure. A project manager manages the budget and the schedule. The logistics coordinator manages the material flow. The site supervisor manages quality. When a client inserts themselves into that process, sourcing their own materials on a different timeline, coordinating directly with trades, making purchasing decisions outside of our approval process, it doesn't reduce the cost. It actually increases the friction. It creates handoffs that we didn't plan for, and it introduces variables our system wasn't designed to absorb. So when that situation comes up, I'm very direct about it. Our service is set up for clients who want a collaborative building experience, meaning they're engaged, informed, and involved in decisions that matter. It's not set up for clients who want to manage their project themselves and feel that their personal contributions should reduce the price. Those are two very different relationships, and we're only built for one of them. Said clearly and without apology, that statement does something useful. It helps the right clients recognize themselves in it, and it helps the wrong clients self select out before either side has invested significant time in a relationship that was never going to work. The clients who respond well to that conversation, who hear it and say, yes, that's exactly what we're looking for, are almost always the clients who become repeat clients and referral sources because they came in with the right expectations, engaged with the process the way that it was designed, and left with exactly what they paid for. If you're listening to this and your current pricing model is somewhere between industry convention and whatever was on your competitor's last bid, here are 5 concrete steps to help you build something more intentional. Step 1, identify which model your business is actually built for. Not which model you aspire to, but which one your current infrastructure supports. Look at your team, your processes, your trade relationships, and your overhead structure. Are you built for price and speed, price and quality, or speed and quality? Be honest. The answer determines everything else that follows. Step 2, audit your current pricing against your actual cost structure. Use the overhead model and costing work from episodes 6 and 7. Are the numbers in the estimates yours, built from your labor costs, your overhead allocation, your risk profile, or are they borrowed from an industry guide built for a different type of operation? If you can't trace every line item in your estimate back to a real cost in your business, your pricing has a foundation problem. Step 3, update your estimating model to reflect your real service infrastructure. Every person, every process, every overhead category that your client is actually paying you for should be visible in the estimate, not hidden in a markup or in a percentage. A dedicated project manager is a line item. Contingency is a line item with an explanation. The infrastructure that differentiates your service should be reflected in the price, and you should be able to explain every piece of it. Step 4, define your ideal client in terms of the triangle. Who is built for what you deliver? What does their project look like? What motivates them? What kind of relationship do they want with their contractor? The clearer your picture of the right client, the more quickly you'll recognize the wrong one. And the more confidently you'll be able to have the disqualification conversation when it's needed. Step 5, build the disqualification conversation before you need it. Write down the language you'll use when a client is looking for something your model can't competitively deliver. Practice it until it feels natural rather than defensive. The goal is a response that is honest, respectful, and genuinely helpful to the client, even when the helpful answer is that you're not the right fit for them. The goal of all of this is not to raise prices arbitrarily or to narrow your market unnecessarily. The goal is to make sure that every price you present reflects the real cost and real value of what your specific business delivers, and that the clients who receive that price understand what they're buying. Pricing clarity doesn't just improve your margin, it improves your client quality. And better clients produce better referrals, better projects, and a calmer business. The compounding effect of getting this right is larger than what most builders realize. Pricing for profit isn't about being expensive. It's about being honest, about what your business costs to run, what your service actually delivers, and who it's actually built for. The builders who price for survival will always be chasing volume, more jobs, more revenue, more activity, because the only way to make those numbers work when the margin is thin is to do more work. That treadmill is exhausting, and it rarely leads anywhere different than where it started. The builders who price for profit build something that compounds. Better margin on each job means more capacity to invest in the infrastructure that improves the next job. Better clients refer better clients. A business that knows what it sells and prices accordingly becomes calmer, more selective, and more profitable over time, not despite turning down the wrong work, but because of it. The triangle isn't just a framework for client conversations, it's a mirror. When you hold it up to your own business and answer honestly, what model am I actually built for and what does my pricing reflect that? The answer tells you more about where the business is heading than almost any other single question. We've spent years adapting our pricing to fit whatever the client wanted in front of them because it seemed like it was the right thing to do. The restoration work taught us that adaptation has limits. You can be flexible about a lot of things in construction business, but you can't be flexible about what your business fundamentally is. Because the moment you try to be all three models at once, you stop being any one of them well. Know your model, price from your costs, hold the number with confidence, and when the right client is sitting across from you, they'll recognize the value before you've even finished explaining it. In the next episode, we're moving into the contracts and risk series. And I think it's one of the most important conversations we'll have on this show because you now know how to cost a job, model overhead, price for profit, and identify the right client. The next question is how to protect everything you've built once the client signs. Because the contract isn't just a form, it's where pricing promises meet legal reality. And most builders don't find that out until something goes wrong. Thanks for listening to Brickonomics, and I'll see you in the next one.